If you bought $10,000 of Bitcoin, then later used it to pay for a $12,000 car, you can owe tax on a $2,000 capital gain, even though you never converted a single cent back to cash. That's because under current ATO guidance, every crypto disposal is a taxable event, and most Australian holders have no idea how many disposals they're racking up. Millions of Australians hold crypto, and a huge share of them are quietly overpaying tax or underreporting and risking a bill later. Today, I'll show you 3 moves to fix it. Audit every disposal you made, separate investor from trader activity, and time your disposals around the 12-month mark. Here's the number that changes everything, 50%. According to the Coinly 2026 guide, if you hold a crypto asset more than 12 months before disposing of it, only half your gain is taxed under the ATO's long-term CGT discount. But here's the part nobody tells you. Sell one day too early and you lose the lot. So here's the plan. Move 1, audit every disposal. Move 2, separate investor activity from trader activity. Move 3, time your disposals around the 12-month CGT discount. Each takes well under 30 minutes and the tools are free. Start with how the system actually works. The ATO treats crypto assets as property, a capital gains tax asset, not money and not foreign currency, so any disposal triggers a CGT event. And disposals aren't just selling for Australian dollars, they include swapping one coin for another, using crypto to buy goods or services, and even gifting it to someone else. Now the impact. Gains on crypto held less than 12 months are taxed in full at your marginal rate, which runs from 0 up to 45%. According to Coinly's 2026 guide, on a $10,000 gain in the 30% bracket, that's about $3,000 in tax. But hold past 12 months for the 50% discount, and the same gain costs just $1,500, half the tax on the identical trade. There's a second, sneakier layer. The ATO says there are no special tax rules for crypto. Your treatment depends entirely on how you acquire, hold, and dispose of it. Investors pay capital gains tax and get the 50% discount. But traders and businesses treat crypto as trading stock, taxed as ordinary income with no discount at all. Here's what that costs. According to Swiftex's 2026 guide, a full-time trader making $50,000 profit pays full income tax, about $18,500 at a 37% rate. An investor with the same $50,000 gain held over 12 months gets the discount taxed on just $25,000, about $9,250. That's over $9,000 more tax for the same underlying activity every single year. Let me kill the most expensive myth in crypto. People believe you only owe tax when you cash out to Australian dollars. No dollars in the bank, no tax. But the ATO treats any disposal as a taxable CGT event, including coin-to-coin swaps, spending crypto, and gifting it. That belief can leave hundreds of disposals unreported. Stack the costs together, and they're brutal. According to Coinly and Swiftex 2026 figures, being wrongly treated as a business can cost $92,500 over a decade in lost discount. Add another $45,000 over 20 years from poor timing and overtrading, and with bigger gains, the lifetime drag easily tops $200,000. Let me make this real. Meet Josh. He's 32. A mid-level software engineer on a $110,000 salary, which puts part of his income in the 30% bracket. He's got about $45,000 across mixed coins and DeFi positions in exchange accounts and a self-custody wallet with 33 years until his retirement target. Here's what he found when he actually ran the numbers. Discovery 1, $6,000. Josh learned that any swap or exchange of cryptocurrencies is a taxable event in Australia, according to eTax's 2026 guide. He'd done 100 token-to-token swaps that year with $20,000 of net gains. And at his 30% rate, that's about $6,000 in tax on transactions he assumed weren't taxable at all, because he never cashed out. Discovery 2, $750 gone. Josh sold $10,000 of a coin after holding it for 11 months, realizing a $5,000 gain taxed in full at $1,500. According to Coinly's 2026 guide, if he'd waited just one more month to pass 12 months and qualify for the 50% discount, his tax would have been $750. a 1-month timing mistake doubled his bill. Discovery 3, the one that surprised him most. Josh earned $2,000 of staking rewards across the year and assumed they weren't taxed until he sold. But the ATO and Coinly's 2026 guide treat staking, mining and airdrops as income, taxed on their fair market value in Australian dollars when received, about $600 at his rate, owed annually as he earns it. Add it all up, and Josh's current habits, frequent swaps, short-term sales, and untracked staking, model out to about $8,100 in extra tax every year. Over 20 years at his 30% rate, that's roughly $162,000 in tax drag he could have softened with 3 simple changes. So could this be you? You've only ever reported crypto when you cashed out to Australian dollars. You don't actually know which of your coins have passed the 12-month mark. Or you've never declared staking, airdrop, or mining rewards. If any of those ring true, the next 3 moves are built for you. Now the good news, none of this requires a tax degree and every fix is legal and free. We're going to audit every disposal so nothing's missed, classify your activity so you keep the 50% discount, and time your disposals around the 12-month mark to halve your taxable gains. Done properly, that's the difference between Josh's $200,000 drag and keeping most of it. Move 1. Audit every disposal. Export your full transaction history from every exchange and wallet for the financial year, the 1st of July to the 30th of June. Run those CSVs through a crypto tax calculator like Coinly to compute your gains and losses, then log into MyGov and check that every disposal shows up in your ATO capital gains section. This is general information, not personal advice. 3 quick steps. 1. Download your trade, swap, withdrawal and deposit CSVs from each platform. 2. Upload them to a crypto tax tool to calculate your profit and loss. 3. Log into MyGov and review the capital gains section of your draft return. Good looks like every disposal accounted for with records you can keep for 5 years. Move 2. Separate investor activity from trader or business activity. List your holdings and honestly identify which are long-term investments and which look like high-frequency or business-like trading. Document any business indicators, regular, organised, profit-driven activity. Then align your records so investments support the discount and trading stock is valued correctly. 3 steps. 1. Separate your long-term holds from your frequent or business-like trades. 2. Note any business indicators because those move you to ordinary income with no discount. 3. Record acquisition and disposal dates to prove your holding periods. Good looks like clear, documented justification that your main positions are investor CGT assets. Move 3. Time your disposals around the 12-month CGT discount. Use your tax report to find which positions are approaching 12 months. Then for each one, model selling now at full rate versus waiting to claim the 50% discount. Then set calendar reminders just after each asset passes the 12-month mark so you can decide with the discount on the table. 3 steps. 1. Add acquisition dates and flag positions nearing 12 months. 2. Compare gain times your rate now against gain times rate times 50% after 12 months. 3. Set reminders just after each asset hits 12 months. Good looks like most of your large disposals taxed at half thanks to the discount. Why does this matter right now? Back in 2014, the ATO first clarified that cryptocurrencies are CGT assets and not a form of money. In 2017, federal legislation confirmed digital currencies aren't Australian or foreign money, locking in their treatment as property. And from July 2027, expert guides flag changes to the 50% long-term discount, which is exactly why planning your holding periods now matters more than ever. Once you've acted, here's how to check it worked. You should see every disposal reflected in your capital gains report in Australian dollars. Confirm your main holdings are documented as investor CGT assets, not trading stock. And if a position passed 12 months, your report should show the 50% discount applied to it. Everything today comes straight from the ATO's crypto asset guidance, plus the 2026 Coinly, SwiftX, and eTax tax guides, all linked in the description below. I genuinely encourage you to read the ATO pages yourself because this stuff changes and your situation is your own. So today you learned that every disposal is taxable, how to keep the 50% CGT discount, and how to time your trades around the 12-month mark. Next, I'm breaking down how the ATO data matches your exchange account and what actually triggers an audit. Subscribe so you don't miss it. If this saved you even one overtaxed trade, do me one favour and hit subscribe. It genuinely helps us keep reading the fine print so you don't have to. And remember, this is general information, not personal tax advice, so check your own situation with a registered tax agent before you act.